Cool. Well, I'll let you kind of introduce yourself a little bit better. Jackson has an awesome podcast I listened to where him and Mike were talking on a podcast, and that's kind of how I got this group together, this idea together about self-directed IRAs and I guess strategic accounts that you can use for investing. Because as realtors, we know that like we don't have any retirement plan, right? Like there's no like 401k or like anything that we have set up. Literally, our only retirement plan is investments, and so this is kind of a really crucial, subject to go over if you are in real estate, particularly, but also can be applied to anybody regardless of where you are or what you're in, whether you have 401ks or not. So, Jackson, I'll let you take it away, and then we'll turn it over to Mike later on.
Awesome, thank you, appreciate it, Spencer, and thank you for the invite. I've been looking forward to this. I'm really excited to share with all of you. And I'll pull up my slides here in a second. But just by way of brief introduction, my name's Jackson Larimer. I'm a financial planner. I opened up my firm about 3 years ago, and I specialize in helping people that are self-employed and small business owners. So I know your lane, and I'm excited to share with you some of the tools that you have available that will really help accelerate your progress when it comes to investing and specifically self-directed IRAs. So I have, so you know as well, Spencer, I think the portion on self-directed IRAs will probably take about 20 minutes to go through. And I want to make it as collaborative as possible. So if you guys have questions, I might not be able to see you while I'm sharing my screen. So maybe Spencer, you can just kind of pipe in and let me know if someone has a question, and I'm happy to be interrupted and answer those as we're going through the presentation together. So don't be afraid to do that.
That sounds good.
All right, awesome. Yeah, let me go ahead and share my screen and we'll jump into things here. Is this full screen for everyone?
Yeah, is everyone got bigger? Right now? Oh, down bottom right, right above the red. Cool. Yeah, we got it.
Okay, awesome. Let's jump into it. So just really quick, why I think you should listen to me, a couple of things. The first one is that I'm a real estate investor. I bought my first home when I was 25, lived in it for 3 years, and then my wife and I converted it into a rental property. So we currently have one rental property, and we'd love to continue to expand on that in the future. You will see that in the financial space, sometimes it's kind of siloed, where a lot of financial advisors are just focused on the stock market. And personally, I believe that real estate and investing in the stock market actually pair together really well and give you some unique advantages and diversification. So both of them are a great strategy for building wealth. Like I mentioned before, I'm a financial planner, so I own my practice, Lemonade Stand Financial. I've been doing that on my own for about 3 years now. And I specialize in helping business owners and people who are self-employed. I am also self-employed, so I know what that's like, not having a retirement plan. And then I live in Northwest Arkansas with my family. I got my degree at Brigham Young University and have a lot of personal connections in the Utah Valley. In fact, a lot of my clients right now actually live in Utah Valley and also invest in real estate in the area, which is actually how, Mike, you and I initially got connected, I think, is because one of my clients was looking to sell their rental property in Murray, and we had gotten connected there. Okay, so I want to start out this conversation of self-directed IRAs by talking about this guy, Peter Thiel. And is anyone in the room, maybe you can raise your hand so I can try and see you on the screen. Is anyone familiar with Peter Thiel, like who he is? Okay, not seeing any hands, so this is perfect. So Peter Thiel is kind of a power behind the throne type of guy. And he's a very successful investor. So he was kind of at the forefront of using self-directed IRAs, and this was back in the late 1990s. He decided to contribute $1,700 into a self-directed Roth IRA. They were relatively new accounts at the time, and he saw the opportunity. So he put some money into this account. And he's like a venture capital, angel investor, startup kind of guy. So he used his $1,700 to buy pre-IPO shares of a company called PayPal. It's a common household name now, but it wasn't at the time. And what happened was those shares of PayPal that he bought for $1,700, fast forward the clock about 5 or 6 years, and PayPal ended up going public, and his shares were now worth $55 million. So he decides to sell some of his shares in PayPal and invests $500,000 into another obscure company back in 2004, which was Facebook. He was one of the initial investors for Facebook. And between PayPal, there were a few other companies, Palantir, Facebook, that he invested in. That $1,700 grew to over $1 billion. And the cycle continues. He's a very successful investor. Here's why it matters for you. Peter Thiel is the perfect case study of how to use a self-directed IRA to create wealth. From that initial $1,700 investment, he now has over $5 billion that is completely tax-free. None of it will ever be taxed. And this is really the power of what a self-directed IRA can do for you. Obviously, most of us aren't going to get the same level of investment returns, but even if you can do just a fraction of that, it will be a great tool in your tool belt. So before we talk about self-directed IRAs, I actually want to back up a little bit and just talk about other types of IRAs, because it's going to give some clarity to the conversation here. So what is an IRA? Most people think it stands for an individual retirement account. It actually stands for individual retirement arrangement. And the reason why these accounts exist is because they're spelled out in the tax code, the IRS tax code. But basically what was happening is companies offer 401k plans. And for people that don't have access to a 401k plan, the IRA was designed as an account where you could still save for retirement in a tax-advantaged way. And what I mean by tax-advantaged is either you don't pay taxes when you put money in, or you don't pay taxes when you pull money out. And we'll look at some different use cases for that. So it's basically a tax-advantaged investing account that you can use to save for retirement. And with that said, IRAs have certain rules around them. One of the main rules with IRAs is when you can access the money. And so you're probably familiar with the 59.5. This is like kind of the magic age at which you can access your IRA penalty free. If you want to pull money out of an IRA before 59.5, there's usually a 10% penalty for doing so, unless you qualify for some exceptions that we'll talk about as well. Okay, so the thing to know here is that it's an account used for retirement. It's going to save you on taxes, but you have to follow the rules about when you access the money. Currently, the annual contribution limit for IRAs is $7,500 per year. And this is indexed for inflation. So last year it was actually 7,000. This year it went up to 7,500. And that amount periodically increases. So you'll want to take a look at that every year and see what the current contribution limit is. Something that you should also know about IRAs is that if you're married, this is an individual contribution limit. So let's say, for example, I'm married, I have an IRA, my wife has an IRA as well. I can put $7,500 into my IRA this year, and my wife can also put $7,500 into her IRA. So our total family contributions would equal $15,000 if we were maxing out our contributions to both of those accounts. And a natural question is, that sounds great. Maybe you're married, but your spouse doesn't work and you're the sole provider for your household. The nice thing is you can actually still set up an account for your spouse and you can contribute on your spouse's behalf. So even if you're a single income family, but you're married, you can set up 2 IRAs, one in your name, one in your spouse's name, and contribute $7,500 to each. The only rule is that your earned income has to be higher than the amount that you contribute. So if for some crazy reason you made less than $15,000 in a year, you wouldn't be able to contribute that full amount. Okay, so that's a little bit of background on the IRA. And there's 2 main types of IRAs, the traditional IRA and the Roth IRA. And these follow a different set of rules of how they're taxed and how you can use the account. So we'll start with the traditional IRA and then we'll shift over to the Roth IRA here in a second as well. Okay, for a traditional IRA, any contributions you make to the account are going to be tax deductible. So just as a simple example, let's say you make $100,000 and you decide to contribute $7,500 to your traditional IRA, that is going to lower your taxable income from $100,000 to $92,500. So basically it's a top line deduction in terms of taxable income. There are some income restraints here. If you make too much money, you actually lose the tax deduction to a traditional IRA. You can still contribute to the account, but it's no longer going to be a tax deduction. So that's something that's very important to be aware of. And depending on how much money you're making, you'd want to take some time and go look up what the current income limits are for your tax filing status. So there's different income limits depending on whether you're a single tax filer, you're married filing jointly, you're married filing separately, or you're head of household. And you'll just have to look up the income limits to be aware of that. Okay, when you put money into your traditional IRA, it's going to grow tax deferred in the account. What does that mean? Well, let's say you open up just a normal investing account, like it's usually called a taxable brokerage account. That account, anytime you, let's say you invest in some stocks and then you later sell them at a gain, that gain is going to be taxed either as short-term capital gains or long-term capital gains. The nice thing about IRAs is that if you're buying and selling investments within the account, that doesn't trigger taxes. So if I put $1,000 into a traditional IRA, I invest that into a stock that grows to $10,000 and then I sell it, I don't have to pay taxes on that $9,000 gain. I can just take that full $10,000 and put it directly into a new investment. So tax deferred. And then the deferred part is when you withdraw money from a traditional IRA, that's when you're going to pay the taxes. And those are going to be taxed as ordinary income. So you can think earned income is the same thing here, which is going to be the federal income tax brackets that go from 0, 10, 12, 22, all the way up to 37%, depending on your income level. Okay. Something else to know about traditional IRAs is that because you're not paying taxes up front, the government eventually wants to be able to collect on their taxes. And so they introduced something called required minimum distributions. And this is basically the idea that if you hold money in your traditional IRA for too long, then the government's going to force you to start withdrawing the money and basically force you to pay taxes on the amount that you're withdrawing from the account. This is a major downside to traditional IRAs, and it's definitely something you want to consider, especially when it comes to like retirement planning later in your life, because this kicks in your 70s. So it's not necessarily a big deal when you're younger, but if you build up a large balance in a traditional IRA, it's definitely going to be a major concern going into your 60s and 70s. Okay, so here's just a basic illustration of how this happens. So I want you to pretend the bucket is a traditional IRA. When you're putting money in, you don't have to pay taxes. And then when you pull it out of the account, that's when you're paying taxes on the balance. I'm going to pause really quick before we dive into Roth IRAs because I think it's important to know the distinctions here. Does anybody have any questions that they want to ask about traditional IRAs and how they work?
Is it based on just capital, like how much growth there was, or is it how much is in that you're taking out combined, I guess, if that makes sense?
For required minimum distributions?
On what you're taxed on.
What you're taxed on is based on the withdrawal that you make from the account. So just a simple example here. Let's say you have a traditional IRA that has a balance of $500,000 and now you're retired and you want to withdraw $50,000 from that account. That $50,000 withdrawal will be reported as ordinary income for that year and taxed as ordinary income. So that's where a lot of retirement planning comes into play, is that you're strategically taking withdrawals in years that your other income sources are lower so that you're trying to reduce the amount of taxes you pay. Does that answer your question?
Yeah.
Okay, awesome.
Question.
Yeah, we got a couple more here, Jackson.
Do we need to set up solo IRAs being a real estate agent? Are you aware of that, or just a regular IRA? Okay. Are you?
Yeah, that's a really good question. So IRAs are actually, you can only set them up as individual accounts. So there's no such thing as a solo IRA. Anyone that is an American citizen and has earned income is eligible to set up an IRA. You don't have to own a business or be self-employed to do so. I think what you're thinking of is something called a solo 401k or a self-employed 401k, which that's actually another great account that you might want to consider as part of your financial strategy when you're investing for retirement. The nice thing about solo 401ks is that they actually have much higher contribution limits. You can contribute up to $72,000 per year to a solo 401k. So, that's basically 10 times the amount that you can put into your IRA. There are some things to be aware of with solo 401ks. One of the big things is you can't have employees. So if you have anyone that works more than 1,000 hours per year for you, they're considered an employee, and you're no longer eligible for a solo 401k. So just depending on how you run your business as a real estate agent, if you have other people that are helping you, the solo 401k might not be the right account for you. But if you're kind of flying solo and just hiring a few contractors here and there to help you with things, then a solo 401k could actually be a great strategy that helps you increase that limit of how much money you're able to set aside each year. Good question. Does that answer it for you?
Yeah, that's helpful. I was late, I'm sorry, did you already talk about the limit of an IRA?
Yeah, so the limit for an IRA is $7,500 per year.
Per person.
There's a catch-up contribution as well. If you're in your 50s, you can contribute $8,500. So a little bit higher contribution limit as you get a little bit older.
Okay.
I have a question.
Yes.
When your distributions are taxed as ordinary income, is that taxed like an active income versus a passive income? Or is
It's
it
taxed as active income. Yeah, ordinary income is just another term for active income. Those are the same.
Yeah, that's great. How do you maximize your reducing your taxable income when you're in retirement, and a lot of it's from passive resources? Like you have a lot of investments, they're all passive. Now you have active. How do you reduce the taxes?
It's a good question for, maybe we can go ask that question after. So that's a good question.
Yeah, I'm happy to answer that if you want to repeat it. I just couldn't quite hear you from the back. maybe
No, you're
Spencer,
good.
repeat that for me. I'll be able to hear it a little better.
It's like a strategy
Yeah, kind of separate question. We'll ask
for
after. That's
later.
okay.
So go ahead.
Okay, awesome. Yeah, hold that thought. We'll answer it at the end. All right, I'm going to keep going here. So on the flip side of the traditional IRA is the Roth IRA. And the Roth IRA is basically the exact opposite of the traditional IRA. By the way, the lady that asked the question about solo 401ks, it's the same thing with a solo 401k. You can have a traditional solo 401k or a Roth solo 401k. So the same general rules apply here. Okay, so with the Roth IRA, contributions are made after tax. What does that mean? It means if I earn $100,000 this year and I contribute $5,000 to my Roth IRA, my taxable income this year is still going to be $100,000. I don't get a tax break for making a Roth IRA contribution. Why would you want to do this? Well, it's because the money grows tax-free within the account. So if I put $5,000 into my Roth IRA and that amount grows to $100,000, that full $100,000 is going to be tax-free. And so if you think of the Peter Thiel example I shared at the very beginning where he has $6 billion in tax-free money, it's because he did it within a Roth IRA. So that's what gave him the opportunity to grow his money and not have to pay any taxes along the way. Roth IRAs are much more flexible than traditional IRAs because contributions can be withdrawn at any time. So for example, I have a Roth IRA and I've been making contributions to it for the last 8 years, roughly $6,000 a year. So I have about $50,000 of contributions into my Roth IRA. If I wanted to use that money to go buy a car tomorrow, I could pull $50,000 out of my Roth IRA, go buy a car tomorrow, and there would be no penalties associated with that. Where this is relevant for you is if you're working with maybe a young couple that's looking to buy a home. They don't have enough money in their savings account for the down payment, but they want to make a bigger down payment. They can access their Roth IRA funds and use that to make a down payment as long as it's contributions. That means you can't use the investment growth within the account. But there actually is an exception here. If you're making a first-time home purchase, you can also withdraw $10,000 of earnings growth from the Roth IRA penalty-free. So, going through the same example, let's say your client is a 30-year-old couple. They have a Roth IRA balance of $100,000. $50,000 of that is initial contributions they made into the account. $50,000 is investment growth. If they wanted to use that account for a down payment, they could access $60,000 penalty free. So that would be the $50,000 that they initially contributed into the account, and then $10,000 of investment earnings. Something that's really valuable to know. Okay, another major advantage of the Roth IRA is that there are no required minimum distributions in retirement. So let's say, you have kids and you want to leave a legacy for your kids, maybe you want to leave an inheritance to them, and you set up a Roth IRA, you can just let that money grow tax-free until the day you die. The government never forces you to take money out of the account since you paid taxes on the front end. So this is a really powerful tool if it's important to you to have that level of flexibility. And it's one of the big reasons why I personally love using a Roth IRA. Okay, here's an illustration of how this works. So if the bucket is the account that you're using the Roth IRA, you pay taxes when you're putting the money in at the top. And then when you pull money out later, it's completely tax-free. You never have to pay taxes again. I'll pause here for a second and field any questions on Roth IRAs and how they work.
Do they have the same contribution limits as traditional Roth IRAs?
Yes, same contribution limit of $7,500 per year. Something important to know is that's actually a shared contribution limit. So You can open both of these accounts. You could open a traditional IRA and a Roth IRA, but 7,500 is the cap. So if you put $3,000 into a traditional IRA, the most you can put into your Roth IRA this year would be 4,500. It's shared across those accounts.
That's good to know. Jackson,
Yes.
on making contribution withdrawals from a Roth IRA, does the 5-year rule apply in that case?
The 5-year rule does not apply.
Not to contribution withdrawals.
Not to contribution withdrawals. Yeah, that's a great question. You can do it immediately. Where the 5-year rule applies is if it's a rollover. So like if you had a Roth 401k that you rolled into a Roth IRA, then the 5-year rule applies. But actually, even in that situation, it only applies to your investment earnings within the account. Any contributions that you make to a Roth IRA, you can withdraw at any time. So just as an example scenario, let's say you put $20,000 into a Roth 401k from an employer. You later left that employer and you rolled that money into a Roth IRA. From day one, you could still withdraw the $20,000 of contributions that you made.
Any other questions? Cool.
Okay, awesome. Let's keep going here. Okay, so now I want to get into self-directed IRAs. What are they and how do they work? A self-directed IRA is simply a traditional or Roth IRA that is held by a different custodian that allows for investment in alternative assets. So you can set up a self-directed IRA either as a traditional IRA or as a Roth IRA. The difference here is that if you go to Fidelity or Charles Schwab or Vanguard down the street and you open up an IRA with them, you're going to be limited to investing in stocks, bonds, ETFs, mutual funds, money market funds, like traditional equity type of investments. So if you open up a self-directed IRA, this is going to expand the horizon for you, where you can invest in things like cryptocurrency, gold and silver, local businesses that your friend owns, and obviously real estate, which is the nature of our conversation today. There is some added complexity with self-directed IRAs. They have some additional rules and regulations that you have to follow that allow you to access to invest in these alternative assets. So I'm going to walk through what those rules are so you can be aware of them. Okay, so why would you use a self-directed IRA? Well, the main reason why you'd use it is because it allows you to invest in alternative assets like real estate, crypto, pre-IPO companies, etc. It's also a shift from a passive to an active investing strategy. If you don't want to have to think very much about your investments, maybe you're looking to diversify away from real estate since your career is in real estate, you already own a lot of real estate, then one of a Roth IRA or a traditional IRA is going to be a better fit for you. But if you want to increase your real estate investments and you're looking to do it in a way that's reducing your taxes, then the self-directed IRA is going to be a better fit. Okay. And then the main reason why you do this is if you believe that you can create an outsized return based on what you're investing in. So if you think that you can make more money investing in real estate than the stock market, you're going to want to choose a self-directed IRA. I'm going to walk through how you go about setting up one of these accounts, and there's 3 main steps that you want to follow here. So step number 1 is choose a custodian that offers a self-directed IRA account. I will say these are not your traditional brokers. So if you currently invest your money with Fidelity and you call them and ask to invest in real estate, they're going to tell you that you can't do that. That's not true. They just don't offer a self-directed IRA. Okay, once you've chosen a custodian, then you go ahead and fund the account. So you put money in. and then you authorize the transaction. So whatever alternative asset it is you're looking to buy. And that's it. It's pretty simple. Obviously, there's some nuance there, but it's a relatively straightforward process. Here are some examples of popular financial firms that offer self-directed IRAs: IRA Financial, Equity Trust Company, and then UDirect IRA. So probably not names that you're familiar with unless you already have one of these accounts. Definitely do your research when you're trying to choose a good provider. All right. Any questions so far on self-directed IRAs?
Yeah, I think you might be about to answer this, but it's just about funding it. So if you can fund $7,500, you can contribute $7,500 a year to a self-directed IRA. Obviously, you're not going to be able to invest in real estate very soon if you're contributing $7,500 a year. So can you roll over from a traditional or a Roth into a self-directed?
Yes, you can perform a rollover. And that's actually the main way that people use these accounts. So to your point, the first way that you can fund it is just by making a direct contribution of $7,500 per year. The main way that you're going to be able to fund this is from a rollover. So if you currently have a Roth IRA or a traditional IRA, you could roll that into a self-directed IRA. What's important here is that you want to keep the same type of account. So if you currently have a Roth IRA, you want to roll that money into a self-directed Roth IRA. And if you currently have a traditional IRA, you probably want to roll that money into a self-directed traditional IRA. You can roll money from a traditional IRA into a self-directed Roth IRA, but that's going to trigger taxes. And that might be something that's part of your strategy because you're trying to transfer more money into Roth accounts. But it's important to be aware of. So if you don't want to trigger taxes, make sure you're performing the rollover into the same type of self-directed IRA. You can also do rollovers from 401k plans. So if you have a different job where you had a 401k before you became a real estate agent and it's just kind of been floating out there, that could be an opportunity to tap into that money and use it for real estate.
A couple questions. Callie had one first.
When it triggers your taxes, is that only on your contributed amount and the gains would still roll over, or will you have to pay taxes on the gains that you've earned if you're going from a IRA to a Roth?
Yeah, so if you're going from a traditional IRA to a self-directed Roth IRA, or even just a regular Roth IRA, you will pay taxes on the full amount of the conversion. So if you think back to the traditional IRA, you haven't paid any taxes at this point on any of the money in that account. So if you contributed $10,000 to a traditional IRA and that grew to $50,000, and you roll that $50,000 into a self-directed Roth IRA, that's going to increase your income in the current year by $50,000, and you'll have to pay taxes on that full $50,000 amount.
That would have been a great loophole.
Yeah, I assume, yeah.
Is there a limit if you're rolling into a Roth? If you're going to be willing to pay the taxes, do you have a limit how much you can roll into a Roth from a traditional?
If you're willing to pay the taxes, there's no limit. Yeah, so you could roll, if you had $2 million in a traditional IRA and you wanted to roll that into a Roth, you could do it. You would just have an income of $2 million this year. The nice thing is it's not all or nothing here. So if you have a really high limit or a really high balance in a traditional account, you can roll that amount over the course of a couple years. So, maybe we'll say you have $600,000 in a traditional IRA. You could break that into 3 years and roll $200,000 per year so that more of that money is getting taxed at a lower tax bracket. Something else to know is the rollover does not change your contribution limit for that year. So let's say, tomorrow you roll over $200,000 into a Roth IRA from a traditional IRA. You can still add an additional $7,500 contribution as your contribution for this year. Good questions.
No question. Sorry.
Go ahead.
With the like required minimum distributions, if you're going from a traditional IRA into a self-directed and you were in retirement already, essentially, would that continue to just be the same kind of minimum distribution, or does it change?
Yes, it would still be the same. So that would actually be a danger that you would want to look out for, that you could get yourself in some hot water. So, you know, walking through that scenario, let's say you have $100,000 in a self-directed traditional IRA, and you use that $100,000 as a down payment on some real estate. And now you're in that age where you have to take required minimum distributions, which is 72 or 73, depending on your current age. So you're 73 years old and they say, hey, you need to make a distribution of, you know, at least $10,000 this year. If all the money you used was for the down payment, you might not have the money to take that distribution, in which case you're going to be in a lot of hot water. So that would probably be an argument for either keeping a sum in cash in the account so that you could make those required distributions, or electing a self-directed Roth IRA over a self-directed traditional IRA.
Okay, thank you.
You're welcome. There's actually another layer of complexity here that I didn't mention earlier, which is that Roth IRAs have income limits. If your income is too high, you can't contribute to that account. And I forget the exact number because it's indexed for inflation, but I think it's $153,000 if you're single and $250,000 if you're married filing jointly on your taxes. So if you're making more than that amount, you're actually not eligible to contribute to a Roth IRA. You can still do a conversion. So if you have existing funds in a traditional IRA or a traditional 401k, you can still convert those into a Roth IRA, but you can't make new contributions to a Roth IRA. There is a workaround for that, which is called the backdoor Roth IRA, that I didn't mention earlier. And basically how that strategy works is if you're above the income limit to make Roth IRA contributions, you actually make what's called a non-deductible contribution to a traditional IRA and then convert it into a Roth IRA. That one, unless people are curious about that, I probably don't want to go too much into the weeds on that right now because it's a little bit of a more complicated financial strategy that you really have to make sure you're dotting your I's and crossing your T's when you do that. Okay, good question though. Any other questions?
Yeah, well,
I have a question about, so once you have rolled your money from the 401k into a IRA and you want to use it for making for doing investments, we were, my husband and I were told that you have to have a manager who manages your payments. How do you know about that? Besides the IRA company, somebody who manages the payments to the investments.
Yes. Are you talking about the self-directed IRA here?
Yeah.
Yes, that's correct. And I think that's actually a great lead into one of the future slides here. So I'm going to keep going because I will answer that question here in a minute. Okay. So let's talk about some of the rules and regulations around self-directed IRAs. The first one is going to be prohibited transactions. There are certain things that you can't use a self-directed IRA to do, and here are the big ones. You can't use it for personal use. So you can't set up a self-directed IRA and use it to go buy a beach house and then, you know, rent it out as a short-term rental, but you're also using it as a vacation home. That's a big no-no. You're not allowed to do that. You also can't put any sweat equity into property that you buy with your self-directed IRA. So if you wanted to do a fix and flip, you could not do that yourself. You'd have to hire out all of the labor if you're using a self-directed IRA to do that type of transaction. And then the last one is no self-dealing. So if you already own a house, you can't buy it from yourself, essentially. If you own it personally, you can't sell that house to your self-directed IRA. You'd have to purchase a new piece of property that you don't currently own. Those are the big ones to be aware of. Basically the government's trying to close a few of the loopholes here that we would all be thinking about otherwise. Yeah, go ahead.
With the no self-dealing, could you have a LLC perhaps or an S corp purchase the property from you, even if you're a part of that LLC?
Let me think about that for a second. So you currently, the property is currently titled under an LLC that you're a member of?
So no, this is just a hypothetical. It's like if you use the SDIRA to like purchase a fix and flip, but then you don't want to, you want to sell it, you want to sell it to like an LLC that you're a part of. Would that be like a way to circumvent the no self-dealing?
I actually don't 100% know the answer to your question, but my gut instinct is that's going to be a no.
Okay.
But with that said, I haven't run into that situation personally, so I don't 100% know that answer. It's possible that you could do that, and I can look into it for you. But my gut instinct says that's most likely, 99% confidence that's going to be a no.
Okay.
Good question. Any other questions? All right. The second part of these prohibited transactions are disqualified persons. Basically, there's certain people that these rules of prohibited transactions apply to. The most obvious one is going to be yourself, but it also applies to your spouse, your parents, your children and their spouses, or your grandchildren and their spouses. So, you can't work around this by selling the property to your kid and having them sell it back to you or something like that. You also can't hire one of your kids to be the property manager. That's not going to work. Okay, I want to walk through a couple examples here just to give you some intuition over what's allowed and what's not allowed when you're buying real estate within a self-directed IRA. So first example, your dad is an electrician and you hire him to install an interior light fixture on a rental property that is currently owned by your self-directed IRA. Is this allowed?
Probably depends on if you pay
Shout it out.
That's right.
Okay, so the answer here is no. This one's not allowed. The reason why this one's not allowed is because your dad would be a disqualified person. You're directly related to him. You cannot hire him because he would be violating the prohibited transaction rule of no sweat equity. Okay. All right. Next example here. Your brother wants to sell his house. He offers you a below market rate and you purchase the property using funds from your self-directed IRA. Is this allowed? Yes, this one is allowed, and it's because your brother is not a disqualified person. So there are some interesting opportunities here. Siblings are not disqualified people. Your mother-in-law or your father-in-law is not a disqualified person. Your best friend is not a disqualified person. Business partners that you have are not disqualified people. So there's maybe some ways that you could get strategic here if you want to. All right, so with that said, what happens if you break the rules and you have some sort of prohibited transaction within your self-directed IRA? All it takes is one prohibited transaction for the IRS to immediately disqualify your self-directed IRA, and all assets within your SDIRA immediately become taxable. So This is like, would basically defeat the whole purpose of the strategy, which is why you just want to play within the rules here. And where you could get in trouble is, let's say you have your self-directed IRA set up and, you know, some sort of maintenance request comes through on this rental property that you own in your self-directed IRA. For whatever reason you forget and you pay for that maintenance request using a personal credit card, you've just violated the rules. That's a prohibited transaction, and you're at risk of disqualifying your entire account. So definitely something to be aware of and make sure you're careful. Okay, I want to, we're going to be answering your question about having a manager here soon. Before I jump into the next part, are there any questions on disqualified persons or prohibited transactions?
Will you share, Jackson, your information if we want to call you and ask questions to see if we're doing something bad?
Yes. Yeah, the last slide here, I've got my phone number, my email address, and a link to my calendar. So you're more than welcome to shoot me a text message if you have a question. That's totally fine. All right, awesome. Let's keep going here. So one of the challenges with a self-directed IRA is that it's at one of these custodian accounts, right, where you set up this IRA. And a lot of times with real estate, you need flexibility, right? Maybe there's a deadline, you're trying to close on a deal. You don't want to have to be cutting through all this red tape to be able to transact using your self-directed IRA. The problem is you're a disqualified person that can't, you know, do those transactions. So is there some sort of workaround? The answer is yes. And it's something called a checkbook LLC. Mike, correct me if I'm wrong. I think you actually used this strategy when you set up your self-directed IRA. So I'm excited to hear more from your personal experience here in a couple minutes. Basically how this works, and I have a diagram here in a second, but you set up a self-directed IRA with the custodian, and that account is in the name of the custodian for the benefit of you, or in this case, what you're actually going to do is go and register a new LLC, and you're setting up the IRA in the name of your new LLC, and then opening a bank account associated with your LLC, and any money you transfer to the custodian to put into that self-directed IRA, they go deposit those funds in the bank account that's in the name of the LLC. So basically how this is working is that the self-directed IRA, that account, owns 100% of the LLC, and then you assign yourself as the manager for the LLC, a non-compensated manager. And then what this gives you is the ability to use that bank account to execute transactions on behalf of the self-directed IRA. It gives you more autonomy where you don't have to go through the custodian every time you have an expense come up. If you have, you know, a maintenance request or whatever on the property, you can use money in that bank account and hire a vendor to take care of the maintenance request without having to go through the custodian. So it's going to be more flexible, it's going to be easier, and it's also probably going to save you on the transaction fees associated with working with the custodian. Here's a diagram of how this works. So I pulled this off of the Equity Trust website, which is why it has their name here. If you look at the left side, you're setting up your self-directed IRA, which in this case is the company Equity Trust. You're also setting up a single member LLC in the middle here. And the owner of that LLC is the self-directed IRA. And then you are the manager of the LLC. Now the custodian, Equity Trust, transfers, you know, money into that bank account of the LLC. And as the manager, you can execute transactions. Really important to know here, any profits or expenses from assets owned by that LLC must flow in and out of that bank account. So any rent that you collect has to go back into that bank account. any expenses that you pay has to come from that bank account. You really have to keep this clean. You have to keep it 100% separated from your personal finances. Otherwise, you're going to violate those prohibited transactions and be disqualified from using that self-directed IRA. I'm going to pause here for a second and go back to the woman that asked the question about the manager. Does this answer your question, or do you have a further follow-up question on it?
Yeah, I have a question. Just as we were, my husband and I were told that we have to have a separate manager besides ourselves who manages the transactions.
So as long as it's in the LLC, like it counts as like a separate entity from yourself, and so that would fulfill that requirement. I think is what it's.
Yes. Yeah, I don't know the exact specifics of your situation, but it's possible that they just want to be designated as the manager on that account so that they can charge you more service fees along the way. Or it's possible that you have things set up differently, and for your case, you would have to have a separate manager. But this strategy of having the checkbook LLC is 100% a legitimate strategy to use.
That could also be referring to who's the property manager. Jackson, do you know if, I was told kind of when I opened this up, I was told by an attorney that you should have a separate property manager who's managing the property. So I'm not interacting with the tenants, collecting rent, that kind of thing.
Yes, that great point. Thanks for sharing that, Mike. That could 100% be the case because you can't be managing that property yourself. So I might have actually misspoke a minute ago when I was giving an example of a maintenance request. You would want to hire a separate property manager 100% to avoid those prohibited transactions where you're essentially adding value and services to the property, which you're not supposed to do. Any other questions, or should we keep going here? All right, let me keep going. And we're getting close to the end here. I think we're going a little bit over time. So appreciate all the questions, though. This has been awesome. Okay, so a couple different investing strategies you could consider within a self-directed IRA. You could do a direct purchase where you buy a property outright. Obviously, the downside of that is you're going to have a pretty big cash balance that you're already working with. You can actually partner with people on these deals. So if Mike has a self-directed IRA and Trudy has a self-directed IRA, you could go in on a deal together to purchase some property, which I think is pretty cool. And then you can also use the IRA as a private lender. So if you wanted to basically hold a note and be collecting interest payments, then you could do that, which is pretty sweet. Like, this is definitely not possible in a regular IRA. So self-directed IRA gives you some really interesting opportunities here. And this is an example of how you could go in with various partners. So on the left side, there's 4 partners. 2 of them are self-directed IRAs, and 2 of them are actually just people using their own personal money. And then you could set up a multi-member LLC and all go in on a real estate deal together. So you can even mix some people using personal money and some people using self-directed IRAs, and then pooling your money together to buy real estate, which is really exciting and opens up all sorts of cool possibilities.
For syndications, right? You can use that towards syndication, and because you're not managing it, it's not your own.
Yes.
Not doing sweat equity.
Yeah, that's a great use case. You could be a limited partner giving that money in a syndication, and that would be a great way to use this. Could be your best friend. Okay, awesome. So that's the last slide I have on self-directed IRAs. And I want to just share a little bit about who I am and if you're interested in reaching out to me to know more. So one thing I do differently from most financial advisors is I'm really focused on holistic financial planning. So understanding your tax strategy, your investing strategy, cash flow management, rather than charging some sort of assets under management fee. I actually just charge a flat rate for my services. So it's just a flat dollar amount, and I'm never going to take a cut of your investments. I also don't manage your assets for you. I just give financial advice. So you get to retain 100% control and ownership over whatever you invest in, which is why a lot of business owners and self-employed people like working with me. So if you saw some value in today's presentation and you want to know more, feel free to reach out to me. I've got my phone number and email address on the screen, so feel free to take a picture of that, and you're welcome to text or email me. The QR code, if you scan that, it will take you to my calendar where you can book a conversation with me. So happy to answer any questions that you might have. And at this time, I'll go ahead and field any other lingering questions that we weren't able to answer earlier.
Any burning questions before we turn over to Mike? Jackson, that was a huge value give. Really appreciate it. I think that was, obviously you charge for this kind of thing, and we were able to benefit from you today. So thank you so much for sharing that information. And I'll probably get people reaching out to you. I know I will be. So thank you so much.
Yeah, you're welcome, Spencer. I'm really grateful for the invite and love doing these things. So I was glad that you thought of me for this. Other thing
you're welcome to stay on if you want. Go ahead.
Well, go ahead, Spencer.
I was gonna say you're welcome to stay on if you want. While Mike shares what he's gonna share about. So Mike Hughes here is my cousin. He actually just bought a rental property 2 weeks ago, a month ago, with a self-directed IRA. So he's gonna share some real life experience on what that process was like. You're welcome to say, Jackson. What were you gonna say at the end?
Oh, the last thing I was going to say is that Mike and I actually did a podcast episode together recently. So if you go look, the name of my podcast is called Money with Jackson. And there's a recent episode with Mike where he shares more about his real estate investing strategy. So if you're interested, that would be a good one to listen to.
Yep.
Yeah. Okay, thanks.
It's very beneficial. Thanks, Jackson. He shared a lot of what I was going to talk about. What I did. So in terms of the nitty gritty kind of how to, Spencer asked me to come and just share my experience, a little bit of background on myself to provide context. I work in banking. I'm a VP of Treasury at a commercial bank up in Salt Lake. Been working in banking for 12 years since graduating from college. But I've also always been interested in real estate and done a little bit of investing on the side. My wife and I own 2 duplexes and then the property that we just bought here a month ago through the self-directed IRA. Ever since I started working in banking, I've contributed to a 401k. It was a Roth 401k, taking advantage of employer match, and didn't actively do much in it, just kept most of it in the S&P 500, and looked up 12 years later and had grown to a decent balance. And I'd heard over the years that you could use retirement funds to purchase a property, and never really looked much into it. And last year I decided I finally would. I saw that, just in my opinion, I think the S&P is a little pricey right now, where we have historical really high price to earnings ratios. People are talking about, the effect of AI if we're looking at another tech bubble like the early 2000s. So I thought maybe this is a good time to really figure out how you actually invest in real estate. I also think with rates a little higher than they have been, average days on market being a little bit higher, could be a good time to kind of rebalance my retirement funds from purely the stock market to real estate as well, and buy another rental, which I'd been wanting to do for a while, but didn't really have the resources outside of my retirement funds. So going over kind of how, exactly how Jackson said it's done. First thing I did was opened the IRA through a custodian. He listed some good companies that are online. I kind of wanted more of a local touch, and so I looked into it and found Bank of Utah. They're a long-established bank. They specialize in trusts and self-directed IRAs. So I went through them. I opened the account. The next step was then I wanted to make sure that I could roll over from my Roth 401k funds into into the SDIRA. And not all employer plans will allow that. Some employer plans require you to, you can't do a rollover from your 401k until you leave the company. Luckily mine did. It was managed through Fidelity. I called them up. They said, yeah, the majority of your account here is eligible to roll over. So once I had that account open, I knew that I could roll over the funds. That's when I started looking for the property. I wanted to do a cash purchase. Yeah.
For those who maybe are married, their spouse works and has 401k, that could also be an option
Yeah.
too, right? You roll their 401k over to the self-directed IRA.
Yeah. Yep. They'd probably need to open it in their own name. But yeah, you could definitely do that. So yeah, started searching. Like I said, I wanted to, I didn't want to pull all my funds out. I still wanted to keep my old 401k, keep contributing so I can have some exposure to the stock market and keep getting my employer match. So I was looking for something relatively cheap. So I found a condo up in Salt Lake after searching for a while, went under contract, and that's when I started to set up kind of the checkbook LLC setup that Jackson covered. So opened an LLC. I found an attorney that specializes in this. As you've caught on from what Jackson is saying, there's a lot of rules and there's a risk there that if you do anything wrong, it could be I didn't want to trigger a taxable event or run afoul of that. So I found an attorney. His name's Elliot Smith, works for York Howell up in Salt Lake, specializes in self-directed IRAs, opening LLCs through that structure. Cost all in about $1,500 for him to give me some really good advice and open the LLC, which was highly worth it. Cause yeah, this is one of those things I thought I'm not going to DIY this. So he helped me. So we set it up to where we opened the LLC. The property is 100% owned by the LLC. The LLC is 100% owned by the IRA. I'm the manager listed in the operating agreement of the LLC. And it's pretty straightforward. Bank of Utah, I'd seen this done multiple times. They kind of helped guide me through that as well. And so I did all that while I was still under contract for the property. We updated the REPC to, from my name as the buyer to the LLC as the buyer. Made sure the title company knew, the earnest money, all of that had to come from this LLC that I had funded with those 401k funds, just to make sure there was no personal money used for anything. Yeah.
A lender involved with that transaction? You have to do the whole thing. You can use it as just a down.
Yeah. So if Jackson's still on, I'd be interested to hear what he says, but you can use it as a down payment. You have to get a non-recourse loan. And so I've looked into this a little bit, stricter loan requirements, since the lender's really only their only recourse if you default is the property itself. So higher down payment requirements. I've seen like 35% from one lender online that specializes in this, probably a little bit higher of an interest rate. I don't think the one I saw offered 30-year term. It was more like 20 or 25-year. So a little bit stricter, but yeah, you can. I didn't want to do that this first time around. I just wanted to do like an all cash transaction, which is why I got something cheaper and smaller. It's just a 1-bedroom condo that was listed for about $145 up in Salt Lake. So I did that. We closed on the property, turned the management over to a property management company, which I've used for my other properties as well. A good one up in Salt Lake called Rise Property Management. And so it was pretty relative. There was definitely a lot of paperwork, more steps had to go through, but in the end, I found, yeah, you can actually do it. It's something I'd always heard talked about, but going through it, it's an actual strategy. I think one thing to note, all of the rental income, like you said, the rental income expenses have to flow through that LLC. I transferred over a pretty good cash buffer, just because if there's ever a large unforeseen repair or anything, I think you probably want a little bit more of a cash buffer in this situation, because if ever I was running out of money, I would have to find some way to fund more into that LLC or into the IRA if I had already met my contribution limits. Could be in some trouble there. So keeping a higher cash balance. As the cash balance, grows from the rental income, my plan is to transfer it from the LLC just up to the IRA and continue just to invest, in stocks or other things at that level. And so that's the plan. And another thing is just, obviously, this is a very long-term strategy, with my duplexes. That's stuff that, me and my family can use immediately. This, obviously can't touch it for many more years, for a couple decades. So,
The last class to not do.
there is something there. Yeah. If something's liquid, I tend to use it. So, yeah. But, yep. It was one of the cheapest things I've seen for a long time. It was days on market. It had been on for like 200 days. So red flags, obviously. I'm like, what's wrong with this thing? Yeah. A lot of meth. Yeah, no. With condos, and I've bought and sold condos before. That's kind of how I started. And then we eventually flipped up into the duplexes. So I had some experience there. One of the big things is the condo complex was majority owned by one family. And so lenders won't lend on it. And so you can get conventional financing. So they tend to be all cash transactions on those. So I think that's a big reason why it was cheaper and had been on market for so long. So, yeah. Any other questions?
That was huge. Thank you so much.
No problem.
Your property being listed.
Yeah, well, because I purchase in cash, absolutely. Yeah. Right. Yeah. So
What do you feel your ROI?
the cash on cash. I don't know about break even, but cash on cash it's going to be about 7%. But then you layer in the appreciation, hopefully over time, and the ROA I should hopefully be bigger. But I mean, my plan over time is to eventually hopefully flip that as I'm, building up more of a balance in the IRA and start hopefully getting, larger properties down the line, and love, in 25 years or 23 years when I hit retirement age to have a few properties in there. That's the goal. So,
The super Halloween theme, and it sounds like there's not there's what called out on how amazing he is, but there's a lot of amazing stuff that he's doing. So if you do have questions, feel free to ask him afterwards. But was it helpful? You're like maybe future classes. I like to build it on top of each other. Stuff that can change the crust. So like LLC, that's some tax stuff straight as well as that, especially for these things like Mike talked about. I put an LLC, and then LLC is owned by the Roth, and then you can either go deeper, go in Roth is owned by a trust. Would that kind of thing be helpful to you with structuring?
Maybe like I'm not going to structuring in the efforts. Like Mike was saying, he called in some people doing that DIY.
Okay.
And maybe to talk more about
Strategy kind of.
through with it and how you can leverage it and stuff like that.
Great. Okay.
I would like to hear like what you pay $1,500 for. Like what was the most thing
Lower.
your takeaways
Yeah.
from you said it was well worth it, and I believe you, and I believe you should seek someone else's opinion, but I like to hear others' experience as well as strategy. Okay, that's helpful.
It's a Navy using ChatGPT isn't the best.
Yeah.
And Bitcoin, right? For this one, right?
No.
Sounds good.